Trent Bradshaw with Bradshaw Financial Planning, and thank you for joining us for Mind Your Money. Today is May 28, 2020. Wanted to bring you a quick market update, but let's talk about the agenda. First off, we're going to touch on unemployment numbers, which were released this morning at 8:30. Secondly, we're going to look at the S&P 500 earnings. Then we're going to talk about that Fed balance sheet. It's very important to take a look at it because this is one of the metrics we focus on. And then fourth, we're going to take a look at the S&P 500 from a valuation standpoint. We've talked about reality versus what's happening in the market. We want to show you some graphical representations of that. Okay, let's jump right in. Unemployment numbers. Let's take a look at the chart. This morning, an additional 2.1 million individuals filed for unemployment in the last week. That brings the total to 40.8 million over 6-7 weeks since the COVID-19 situation started. It's unprecedented. To get that percentage, you've got to go back to the Great Depression. Again, it's definitely a negative from a reality standpoint. But the market's looking at this as potentially improving drastically over and above where we were. So even though we've got 40.8 million individuals unemployed, ultimately the market took it as a positive this morning and again held up pretty well for the beginning action of the day. Secondly, what we want to take a look at is the S&P 500 earnings. About 95% of the companies have reported year over year a reduction of 7.5%. earnings year over year. One of the other areas that I want to point out is the financials. Normally a full-blown recovery will not occur without the banks. Well, financials, negative 35% growth year over year during the latest reporting cycle. Again, not a positive, but yet we may be looking at a transition to where technology and healthcare, which have been really good, over to the financials and industrials. We'll have to keep an eye on that, but there may be a transition going on at this point. Why is that occurring? Fundamentally, it doesn't speak to that occurring, but we're actually seeing it in the last couple days to a week here in the market. Next thing I want to touch on is that Fed balance sheet. We've talked about it before. During quantitative easing 1, 2, and 3, which was during the financial crisis in 2008, there was a lot of back and forth whether certain blocks of money were going to be released into the system or not. The Fed wasted absolutely no time this time. We call it quantitative easing 4. But they've issued, right at this point on this chart, about 1.75 trillion, but you can bring that up to about $3 trillion currently is where we're at. The Fed, again, wasted no time, flooded the system with liquidity, dedicated some of that money to be able to purchase corporate debt, also even junk bonds, which basically backstopped the debt market itself, which gave some stability in the market. Market loved it. Market rallied off of that news. But the fact of it is the Fed going to continue to bring the same level of liquidity that they brought in at the beginning of this situation to where we are right now? Well, look at this next chart. What you'll see that the Fed was coming in with 50 to 100 billion on a daily basis. That is reduced to about a $3 to $5 billion number on a daily basis, which is still a big number, but much less than what we had at the beginning. When the Fed stops bringing the liquidity, that becomes a concern because will the market continue to rally off of that? Well, right now, you've got a lot of optimism that the recovery of this COVID-19 situation is going to be a lot quicker than what we've seen in the past. We'll keep an eye on it. If we need to make adjustments in the portfolio, we definitely will do it. Last chart I want to touch on is S&P 500 and what's occurred in the market versus what reality looks like normally throughout a recession. And we're most definitely going to have a recession after the second quarter earnings are reported. But on this chart, what you'll see, S&P 500 obviously has rallied, which is the large cap index. But ultimately, if you look at a 20 PE, which is considered overvalued, hey, we're 10% above that right now. If you look at fair value, especially when we go through a recession, that's down around the 2,000 to 2,100 level. That's about a 30% correction from where we're at right now. Again, will we go back and test the bottom? Don't know that for sure, but one thing we do know with the comments out of the Fed, they're going to step up and bring that liquidity if they need to bring it to be able to support the economy and small business and other areas going forward. So that's been a positive and the market's reacted off of that. If you've got any questions, feel free to give us a call or shoot us an email. But please join us on social media, Facebook, LinkedIn, Twitter, and then also take a look at subscribing to our YouTube channel. I think you'll get some information throughout the week that will be very helpful, and we appreciate your time. Trent Bradshaw, Bradshaw Financial Planning. Mind your money. Have a great week.